Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our Tuesday Night Podcast. We are live. I don't know what just happened to our intro, but I don't have a visual here. It's playing again. Now I got echo. Hey guys, just bear with us a second here. We got all kinds of things happening. I got echo going on in my ears. Must be the shirt that I'm wearing tonight. I don't know. But welcome to our Tuesday Night Podcast. Terrible echo.
Okay,
it's really
that's
not
all
my
right.
shirt. I promise you. But welcome to our Tuesday Night Podcast. And I think we got our issues all straightened out here tonight. It must be also because we're taking a break from talking about the housing market, and we're going to talk about the commercial real estate market because that seems to be going nuts. And we have a really good guest tonight. He's been on our show before, but he kind of hovers around in the commercial real estate space. And I've done quite a few real estate transactions myself, my own commercial real estate. So this is something that kind of hits home with me, what's going on. Especially, I have one of my properties coming up for refinance at the end of this year. We're going to talk about what's going on and why these banks are really, really concerned. We're going to touch all the, all the sectors of commercial. We're going to focus in on really office space because that seems to be hurting the worst. But anyway, we'll get started tonight. Melissa, another Tuesday night.
Another Tuesday night. Hi, Todd. Hi, Orlando. So awesome having you. But, Todd, I need to ask, is that a direct mortgage loans t-shirt?
It is, man. I look pretty good in orange, don't I?
I like it.
I like orange.
I like it. It looks good on you.
Well, thanks.
You're welcome.
Yeah, anyway, this is one of our preferred lender partners that we have. And so I'm sporting their gear tonight, direct
I like it.
mortgage loans. They're actually licensed in 23 states. Not that we're talking about residential mortgages, but since Melissa and I brought it up, they're helping people in this crazy market that really, I mean, loans aren't very affordable right now. There she is right there,
She is,
Pamela
Pam.
Brahman. Again, 28 states. If you guys need help buying a home, if you are in this market, trying to buy a home with these outrageous rates, they're getting, clients about as great a deal as they can. And there's a lot of different programs. But if you're interested, you can reach out to Pam. You can also send me an email. But anyway, let's jump in. Orlando Minor, man, my man.
Hey, man, I really appreciate you bringing me on the platform. We've done this before, but I love coming onto the platform. It's always so easy talking to you guys.
What kind of poison pills you got for us tonight?
We'll see. We'll see.
I got my potion here. Huh? I mean, usually I'm drinking Red Bull or now lately Celsius or never water. But I've got my my special potion here. This is actually keeping me safe from the things that you're going to talk about tonight. I just got clear the air. I know you're gonna really. You're going to fill us in on what's going on, man. How bad is it?
For sure, 100%. It's getting tough. It's getting pretty bad.
Well, what are you going to talk about tonight?
Well, we talk about some commercial stuff. Obviously, we're talking about the office. We're talking about some multifamily. Talking about exactly where I think rates are going to go and what I actually think is going to happen in, I don't know, I say about a 1-2 year period.
1 to 2 years. All right, let's dive in. Well, is it, what's all the chatter that's going on about the regional banks? I hear all this in the news about how regional banks could be in trouble. I mean, there's an article that we can pull up here. It says the share of commercial real estate loans by lender type says out of $4.5 trillion in U.S. debt backed by income producing real estate as of March 2023. They have some interesting breakdowns here. Agency portfolio and mortgage-backed securities are 21% of this debt. Looks like life insurance companies own a bunch of this commercial real estate. 135 regional banks own 14%. Life insurance companies are said to have owned 15% of the debt. Joe, are we having a hard time finding that? That's the first link there. Commercial mortgage-backed securities, collateralized debt obligations, and other asset-backed securities. 13% owned of the commercial real estate debts owned by these types of debt. Top banks, 12%. Community banks, 829 banks. Community banks across the U.S. own 10% of the commercial debt. There we've got the visual up now. And then 3,726 banks. This is to me, I mean, this seems like a lot of people are involved in commercial income producing real estate.
Right. Yeah. I mean, I think the biggest thing here that at least I see on here is it's the regional banks, right? That's what's highlighted on here. And it's because a lot of regional banks love commercial real estate. They do, from office building, retail. For the longest, it was, hey, if you can't go to the big guys, go to the regional banks. And some of the bigger guys like Wells Fargo would, that have some ownership in the regional banks would go ahead and push a lot of that business towards those regional banks. So it's really big business for the regional banks to do and be in this, but it's one of those situations where they're just, kind of like all your eggs in one basket scenario.
Well, with the regional banks, they're doing a lot of the owner occupied space. So, when we think about commercial real estate or, investment type of real estate, what we're really discussing tonight are a lot of businesses buy their building or their location. And, a lot of these regional banks are really like that. They want the businesses, I'll take our business, for instance. I mean, we own the real estate or we're buying it from the bank. But, they were very eager to give me a loan because my business is the main tenant in this one particular property. And so there are a lot, they like it when, a borrower is the actual occupant of the commercial space. And then what the regional banks, of course, want is all your deposit accounts. So they want the small business to actually dump their money into the bank. And they're like, hey, if you could put the majority of your money, your operating account, we would love to write this loan for you. The problem is, in the regional banks, the problem is that a lot of businesses are struggling, right? So they're having a hard time, at least if they have other tenants, maybe they have a high vacancy rate. And like in our situation, and a lot of people don't realize, but when people get a loan for a commercial property, you have like a 5 or 10 year term on average, right?
Right.
And then what happens is, like in 2017, there were a lot of this debt. And then now we're 5 years into it, and it's coming up for refinance, right? And so a lot of the banks now are looking and they're eyeballing these properties, and they're like, "Wow, you've had your bank accounts don't look so stout. Your vacancy rates are high." And so, what is this creating for the bank, or more importantly, for the building owner in this case? What kind of problems is this creating for them?
Well, I think the biggest problem, let's just start with the banks, right? So the bank is looking at it and they are thinking to themselves, how can we get out of this loan? How can we get our money back? But they also know, when they look at the accounts, because they have all your deposits, they can see that the individual is struggling, that the business is struggling. So now it becomes a situation where you talk to your workout department and you think, okay, if we take this back because it balloons at the end of its term, what is the open market like for us to get that property back? If we do a refinance, will the borrower be able to bring more money into the deal because the value is probably dropped on that? And so, the bank is trying to figure out a way to come out of this situation clean and come out of it whole. But the truth of the matter is there really is no way for them to come out clean and whole. Right. And in one portion of it, yes, they may be able to get someone to come in and take them out and they get their money back. But in majority of the cases, they won't be able to. They're going to have to take a haircut somewhere. And if you have a big portfolio of commercial properties to do that in, you can imagine taking a huge haircut on all of those loans that are coming up due. It's just a catastrophe on the banking side.
So what are they going to do? I mean, let's take a scenario here, right? Let's say a buyer buys a property for $5 million, right? And a typical down payment in the commercial world is, I mean, it could be as high as 30%, right? Depending on the appetite of the bank, depending on whether you're an owner occupant, right? Being an owner occupant, maybe that would drop that down. I've seen even as low as 5% down for the business owner to buy a location. But let's just say that the owner put down 20%. So you have a $5 million purchase, you put $1 million down, right? So you're financing $4 million. And now all of a sudden, the bank it's time to refi. So the bank's calling you up, whoever your loan officer is at the bank, calling you up and saying, "Hey, Todd, it's time to refi." And so, of course, they want all the financials. In most cases, they're getting them anyway, right? They get them directly from the accountant. That's part of your that's part of your promise in your loan docs is you're going to provide them with at least a yearly financial statement. And over the last course of the last several years, a lot of businesses have been struggling. Let's just say you've had high vacancy or your sales have been down. And now all of a sudden they're looking at the property and maybe the value has even declined in commercial space. What's the bank do? So if they come back to me and say, "Todd, we really want to refi this for you. You owe us, a little less than $4 million because you've only been in for 5 years. Maybe you owe 3.6 or so million dollars. And, but we only really want to finance $2.5 million. And we want you to put another $1.1 million in cash down, or we're not going to refi the note."
Right.
I don't have the cash. So now what? What's the bank do? Are they going to foreclose on me?
Well, the bank, yes. They're going to foreclose on you. But here's the thing. It's going to get creative, right? It's going to go, okay, so what do you have? Do you have an extra house? Do you have a rental property? We're going to look at all your assets. We're going to try to figure out how we can put seconds on some of these assets to ensure that, that if we have to take it all, because the loan doesn't work out at the end, then that's what we'll do. So there'll be some creative financing, things in there when it comes to trying to get you to over that $1 million hump that you say you don't have in liquid. We'll even ask people, hey, 401ks, what about that 401k you have? What about those stocks that you got? Cash those out. Those are going to be the conversations that are going to be had for you to continue on with the loan, because the value is plain and simple. The value has dropped on the property. It's not worth what it was when you purchased it. So for us to do the refinance, there's that choice. And then the other option is that we would have to raise our LTV. And maybe that would be a situation that most banks would do if your case was a one-off scenario. But if we got a whole portfolio, how can we give you 80% and then give everybody else a 70% loan? We can't. So you may want to just kind of, as a bank, cut your losses, try to get as much as you can, write off the debt, and keep it moving.
So they don't care that I've made my payments every single month on time.
No. I mean, we listen. The truth is that a bank wants to give you the money. They want to extend it to you. But if we could see the writing, if a bank could see the writing on the wall and they kind of know where it's going to go, and on top of that, the property value is dropping at the same time. In a bank's eyes, it's a lose-lose scenario, no matter how great of a customer you were previously. So that's what's going to happen. They're just going to cut losses and continue on.
Now, do these banks, do they have federal regulators on the commercial side that's really, keeping them in line and looking at their performance on their portfolio?
Oh, yes, for sure. And hence the reason why you can't, you have to have the pot. The pot has to be leveraged at some point. You can't just go in and give a group of people 90, 80, 100% loans, but then have another sector that you only give 50, 60 to. It has to be, you have to level out. There's exemptions, right, for certain things that happen in a loan, but you just can't go in there and just go, yeah, just because I like you, I'm going to go ahead and give you a 90% loan to value. It just doesn't work that way.
Do you have any idea how many of these regional banks, their portfolios, what percentage is actually coming up for refinance, say, this year or next year?
I would say in the next 2 years, you're probably looking at 70%.
70%.
70%
of the commercial loans in regional banks right now will be up for refinance.
Correct.
And what's the interest rate right now, on average interest rate on commercial?
It really depends, but I would say just all across the board, you're easily looking at 9%.
Yeah, so these 3.5%, 3.75% from back in
they're
2017 are gone. So, and that's the other issue. I mean, for a lot of these people that are holding these commercial buildings, and a lot of people think that they're non-recourse, that a lot of these loans are non-recourse, and they're not. I mean, when you're talking about, maybe $5, $6, $7 million properties down, a lot of these are backed personally by the, the guarantors or the owners. It's not until you really get into the big, properties where they're non-recourse and, where they're just going to toss the keys back to the bank and say, good luck, you're the proud owner of a vacant office building.
Well, yeah, that's true. So you're looking at when you look at the regional banks, those are almost all of them are recourse. When you get into the CMBS loans, insurance loans, stuff like that, those become non-recourse. But those loans are massive. I mean, they're huge. So there's a difference between $100 million office building, versus your $3 to $5 million, regional bank that a regional, and normally an insurance company won't even touch something that small. A CMBS loan, they won't touch any of that stuff. They want loans that are 20, 30, 40, 50 million and up. They don't want to mess with the small, what they would consider small loans. They'll give those to the regional banks. And then, of course, the smaller the loan, of course, you're going to have the recourse on it.
So, so the question is, are they giving more favor to the ones that are going to dump the keys off at the bank's doorstep and say, it's your office building now, keep it? Or are they going to be more inclined to say, oh, no, wait. We can increase those, debt values to the, to what the appraised value is for the building. Just stay in it. I mean, are they going to try and, coax these types of owners to keep the real estate where the small business will just get squashed?
Okay, so there's a difference between a regional bank and what a life insurance company can do. So a regional bank is underneath what you were saying, those federal regulators and whatnot. An insurance company can mold and kind of do, it's kind of like a family office money, where they can kind of figure out what works is private. So they get to decide exactly what works, how they can make it work. So of course you're going to have the bigger loans being able to, to try to maneuver and work out a situation maybe in the borrower's favor, so that they don't walk away from it. Because again, it is a non-recourse and they're just going to hand the keys back to them anyway. So if they can figure out a way on these life insurance and these bigger loans to actually keep the individual owning it and working out of this situation, they're going to do that.
I heard a billionaire talk about debt, in comparing, like when you owe money to the bank and when you're in trouble, when you can't make the loan, right? And so the statement was made, how do you get banks when you go through financial hardship as a, somebody that owns billions of dollars in real estate, how do you get the banks to actually work with you? And, the billionaire said in this scenario, look, when you owe a bank $100,000 and you can't pay them back, you're in trouble. But when you owe a bank $100 million and you can't pay them back, they're in trouble. So they're more inclined to work with you then, right? So, I mean, the key is just owe them a lot of money and then you can, have better terms. But anyway, I want to look at some statistics here. Office vacancy rates, according to businessnewsdaily.com, and I've seen this on CoStar and a couple different places, it fluctuates anywhere from 12 to 14%, but they're saying that office vacancy rates right now are like averaging 12 to 14% nationwide.
Oh yeah,
That's huge. That's a big
pretty
number.
bad. It's bad.
And this one article on insight.kellogg goes on to say some trends are actually getting worse. Unfortunately, things might get hairier for banking systems before they improve. That's because a few worrisome economic trends will only put more pressure on regional banks in the coming months. The first of these is the flailing commercial real estate market, what we're talking about now. About 30% of the assets at the nation's 4,500 small to medium-sized banks are commercial real estate loans. And like you said, it says that these loans are maturing. It says in 2017 or so, when these 5-year loans were made, the real estate market was on a tear. So what do investors want to do? They want to borrow as much as they can because that's what we talk about, right? Borrow as much. Debt is good, make money on the bank's money, right? Until we're in a situation like now. Yeah, but interest rates have since skyrocketed. No kidding. 9% commercial loans, making new loans more expensive while demand for office space has plummeted with vacancies, this article says, approaching 50%.
Yep. That was more of what I thought, from what I know, as far as what I hear from the industry is about it's pretty high. It's like 50-60% office is vacant as far as vacancies go. It's going up as high as that. I don't know if there was a news article that came out today about a office building in Chicago that was previously bought 3 years ago for $75,000. Today was bought for $32 million.
Wait a minute.
$32 million.
It sold for 75. Oh, when was that? Like back in 1700s or something?
No. No,
What?
that was 3-4 years ago.
Man.
When the market was just so hot. But here's the thing.
You said it was $75,000 and it's how much?
No, 75 million.
Oh, 75 million. I thought you said
75 million.
And I was thinking, like, I'm picturing horses tied up out front.
No.
Like saloon doors and stuff. Dirt floor.
Yeah. Maybe I misspoke, but it's 75. It was worth 75 million. It was purchased back in about 3-4 years ago, and now today's
more than half price,
or half of that. Yeah, half price.
Wow.
So that just shows you where the market is going, and it's because of the vacancies. The vacancies are so high, and they're continuing to go up.
So what are they doing with the space?
Nothing.
Is this going to sit vacant? Are they converting it to office space? I mean, to apartments?
Here's the problem with that. I know that's like a really big thing, but it's so hard to convert an office building over into an apartment building. One, code, zoning. There's just a lot of things, and it normally costs more than what the property is worth to convert it to that. And a lot of cities are strapped for cash, and they don't want to give the tax credits. They don't want to make it an opportunity for the developer to come in and do that, because they think to themselves, I'm kind of basically giving you the property for free. Like, by the time that I give you tax credits and we get everything squared away, you basically bought the property without really putting any money into it. And if you look at San Francisco, that is a prime example. I mean, I was in San Francisco a couple of months ago. You go downtown, it's zombie land down there. It's nothing. Empty building after building after building after building. And the city is trying to figure out a way to convert all of this office space into apartment buildings. But as we all know, California is one of the hardest places for zoning and developers to build anything. So So it's going to take 4, 5, 6, 8, 10 years before they even get through all the red tape. So most developers don't even play around with that.
Well, according to California, everything's bad for you anyway. I mean, when you buy stuff at the store and it says, according to the state of California, this product or whatever, if you toast your bread in it, it's going to cause birth defects. I mean, they have their whole, I don't even know, man. California has its whole other host of problems. I was looking at an article, maybe it was a couple weeks ago, where this federal building, they were actually sending a memo out to their employees telling them to please stay home, that there was so much crime happening outside of the building that it wasn't safe for employees to come. I mean, I don't even know. And this is the big thing, Orlando, because maybe you can speak to this a little bit. What a lot of people don't realize is they go, well, who cares, right? We're in such a crisis right now in the housing market with affordability, right? I mean, it's terrible. And, people want to argue and say, the housing markets and prices are only going to go up, blah, blah, blah. And we know that people can't afford it. The housing affordability index sucks. I mean, nationwide right now, it's at 70. Oh, I've got a video coming out on that. I don't even want to talk about it because we're not getting into that tonight. But let's just say all across the nation, everyone can agree we have a crisis going on with housing affordability. And people are saying that it'll never come down. Well, a couple things are happening, right? Like you just mentioned, when you have vacancies happening in an area, you see malls closing down, you see stores going out of business, you see board ups, right? And I've been in commercial real estate. I mean, there's a term, right? Going dark in the commercial real estate business, right? You get a shopping center and the lights go out in one store, right? It's going dark. The lights go out here. Next thing you know, the next vacancy, the lights go out there. Next thing you know, you have loitering that starts taking place in the strip, and your other tenants start to suffer because now we don't have any kind of cross-selling going on, right? Because we try in commercial real estate to put a tenant composition together that works, right? So that they kind of offset, help each other a little bit. The same kind of customer can go to one store to the next store to the next store. Well, then people don't feel safe going there. And then the other businesses start struggling too. And we've all seen it happen. And next thing you know, the whole center goes down the tubes. You've got community convenience centers, right? These small 8, 12, 14,000 square foot centers where you have a lot of local shops, maybe local restaurants, things like that, dry cleaners, sub shop, whatever. But a lot of people don't realize that this is going to affect everybody. If we start seeing a big commercial crush or commercial shutdown, this is going to affect our neighborhood values.
Right. And one of the things I think that a lot of people don't really, don't understand is that there's a lot of businesses around these office buildings that get a lot of business, restaurants, like you were saying, like you said, dry cleaners, whatever it may be that's around. And if that office building isn't there, all of their business is gone. It's evaporated. So what happens to that coffee shop that was right next to that office building that was getting people coming in the morning, lunch, and then maybe getting something on the way out, going home? That business is gone. That business is gone. What are they going to do? Are they going to go open another business down the street? More than likely, they're not. More than likely, once that business shuts down, they're going to go find work elsewhere. And so you're not only are you seeing the effects of, the office buildings getting shut down and it having high vacancies, right? You're starting to see other businesses around that starting to decay from the center outward.
And, a lot of times, Orlando, they will, and we'll take some questions here, but a lot of times, these businesses have credit lines, right? So they're relying on, inventory. I know a lot of businesses, friends of mine, they have to buy inventory. They have to stock stuff so they don't sell it if it's perishable, like what you're saying, the coffee shops, the, sandwich shops and things like that. They end up throwing things away, right? But a lot of these people have credit lines because they have to, build their bid. They've got to pay their rents, keep the electric on, which is expensive for businesses. And a lot of the credit lines are getting shut down.
Yeah. Not
I mean, if
not
you-
only
if-
are the credit not only are the credit lines getting shut down, but the interest rate has continued to go high. These credit lines, I can promise you, they're not fixed. They're variable.
Oh yeah.
Just like any other type of credit line is. And when you go swipe your credit line because you need more inventory and it's 10% now to swipe it, or 13%, it's eating away at your bottom line. Are you going to raise prices now, and push away customers? You have to make that choice, because now your costs are higher. And so you're starting to see a lot of businesses. I don't know if you on social media, where you're saying, look, this is too much. Inflation is destroying my business.
Yeah. I think people in general, and that's something we'll talk about, but people are spending less money. I think what's happening is, as housing affordability has really diminished, and we're seeing people 40-50% of their pay, especially renters, going towards, keeping a roof over their head. They have less money to spend, right? I mean, we're not seeing the spending, that we experienced a couple years ago, with consumers. But here's an article in Wall Street Journal. It says, credit lines cut. Banks are tightening lending standards. Small businesses are paying the price. Some entrepreneurs are finding it more difficult to get a new loan or have had existing credit lines cut. Others report stricter terms, higher borrowing costs, just like you said, Orlando, and longer waits and tougher questions from their bankers. And you think about this. I mean, a lot of businesses too put orders in ahead of time, right? They're putting pre-orders in for the next season, and banking on those credit lines that are getting cut. Let's take some questions.
Okay. We have a super cash chat.
Super
here.
cash chat. Man, she cracks me up. Call whatever you want, Melissa.
All right,
thank
thank
you so
you.
much. That's so kind.
What do you guys
Charles.
think about Klaus Schwab maybe going under? Apparently, they have 158 billion in like 1.47 interest bonds. They are laying off and closing offices.
Orlando, are they too big to fail?
Probably. I think that there's going to be someone who props them up, and I think that all of those bonds that they have eventually, they'll figure out a way to make it work. Will they take a hit? Yeah, they will. Are they gonna do what all these corporations do, which is, before they figure out anything else, let's get rid of people. Let's get rid of employees. Yes, they're going to do that. And they're going to see if that gets rid of, if that brings down their risk. And they're just going to keep going down the line until they figure out what puts them back in that profitability sector. But I don't see them, going poof away. It's just in my opinion.
But what about the Big Short? What about when the stock market crashes?
Well, I mean, we'll see what happens with that, but I just don't really think. I think in general, I just think that they're huge. I mean, I just don't see them really going anywhere, and somebody's going to help them out. BlackRock, somebody. Too much money.
I love your laugh, man. I gotta tell you,
We had a comment here that just said that.
you guys never been over to Orlando's channel, man. You have got
literally
to
has
check
the
him
best ones.
out. He has got an amazing YouTube channel. He
Thank you.
really teaches a lot of what he's talking about right now. But great channel and great laughter. He's got a good heart. So we appreciate you, man. We always love
Thanks,
to
man.
have you on our channel. All right, let's keep going. What other questions do we have?
Yep. So we did have a question. I think a lot of people probably do not know the answer to this as well. Are commercial loan rates typically higher than home loan rates?
Yes, that they are. They are. Yeah, they typically are. So when interest rates were at the lowest, let's say 3%, right? commercial loans were about 5.5%. So you can kind of look at that and kind of tell we're residential now, what, 7.5, something like 8%, something like that. So
Yeah,
you add
over 8
2%
in some
on,
cases.
right? You put 2% on top of that, and you're probably 9, 10 commercial.
And a lot of people don't realize, just for clarification, most of the investors that are in residential real estate have commercial loans. I mean, if it's not an owner-occupied loan, technically it's a commercial loan. Now, there are investor loan products that are out there, that are, like Freddie Mac kind of loans that you can have, Orlando, up to 40 units if you bought 10 4-unit dwellings, right?
Mm-hmm.
Yeah, but most commercial, most of these single-family loans, loans for rentals are in fact commercial loans. And what that means is, like we were describing, your balloon comes in either 5 or 10 years, depending on, what bank you have and how much they respect what you do, right? If you have a lot with the bank and, some banks would give you a 10-year balloon, and then they amortize those payments over like 25 years. And so,
Right.
That way your payments aren't really high, but actually it's a good thing because you pay a lot more down in your principal balance than you do with your home. So it's actually not a bad deal to, amortize your loan for 20 or 25 years, and paying more down on that principal. So what else we got?
How about this one? How will triple net lease rates do moving forward?
I don't know. I mean, so as far as triple rate goes, I'm starting to see a lot more, consolidation in that realm. Used to get, and for triple net, I used to see, all of these, let it be like a Walgreens, or let it be like a CVS, or some of these other triple net places. And you would see the rates like, would be, they'd be pretty, 5, maybe 6%. I think they're going to tend to go up because of the consolidation. Walgreens and CVS have kind of shut down on some of their stores, leaving a lot of, individuals who bought those type of properties kind of hold the bag in those scenarios, because it's very hard to once that those leases end, everybody knows the shape of how a Walgreens looks. You got to really retrofit it, convert it, turn it into just a box to really resell that back out. So normally those properties are vacant for a very long time. So yeah, I see it consolidating and it going up.
Yeah, I do quite a bit of commercial, as far as lease work with tenants, and leases work with tenants and property owners. And, a lot of the triple net stuff. So, when we're talking about when you rent a building, like Orlando's talking about, or maybe it's a multi-tenant,
Right.
situation where you have let's just say a retail center, or you have an industrial park that has, 100 or 70 or however many individual spaces. What happens is you pay a lease rent that's X amount of square foot. So, if it's office space, maybe it's $10 or $14 a square foot, depending on where it is. If it's retail, maybe it's anywhere from 21 to 54 or more per square foot. New York City is obviously ridiculous. DC is ridiculously expensive. But let's just say you're paying a $20 square foot lease, for instance. A triple net means that the landlord passes everything through to the tenant. Now, if it's a standalone building, that tenant pays a lot in triple net. But if you can share the cost with, let's just say, 25 or 70 other businesses, but what you're looking at is, common area lighting, parking lot expenses, snow plowing, grounds maintenance, improvements, capital improvements. Now we're even seeing in triple net where the landlords are passing along roof repairs. So they're literally not paying anything. And let's just say a tenant's paying $20 a square foot for a property. They're on top of that triple net cost could be $5 or $6 a square foot. So they're actually paying $25 or $26 a square foot. Now, just to kind of analyze that a little bit, break it down a little bit, what does that mean? What does a $20 a square foot price mean with how much they pay a month, right? So typically your square foot pricing in commercial leases are for the year, right? So, and then you divide that by 12. So let's just say you have 1,000 square foot, right, at $20 a square foot. That's a $20,000 a year lease divided by 12, and that's what they pay every single month. But then you got to tack on that triple net, like I just said. So what happens is the triple net fluctuates. So if you have let's just say, not counting now when we've seen everything for building owners skyrocket, like taxes, insurance, repair costs, things like that. Over the last 3 or 4 years, they have shot up enormously compared to running historic averages. But what happens is when a tenant would really see their triple net change a lot would be, let's say you get a blizzard, a historic blizzard. Let's just say that the center where you're renting from budgets $10,000 a year for snow plowing. And that's how they figure everybody's pro rata share of that $10,000 snowplow budget. You get a blizzard and they spend $100,000. Usually you get an assessment on that triple net, right? The tenants get assessed because the landlord went over budget. But now what we're seeing is it's not just blizzards. It's the fact that their insurance rates have gone up 40, 50%, right?
Yeah.
Their repair costs have gone up 50, 60, 100%. Their property taxes have skyrocketed. So these people that are locked into these leases, let's just say for 5 or 10 or 20 years, man, they're stuck. They don't have a choice. Whatever those triple net, you may lock in your lease, payment increases at 3% or 5% a year, but there is no lock-in or cap on the triple net. So very good question. I think that's one of the things that's really hurting business owners.
How about this one? If the credit lines of small and medium businesses vanish or shrink, what does that do to the luxury homes market whose owners are these same businesses?
Yeah, that's a good question too. I showed a house. Go ahead, Orlando.
Go ahead. No, you go first.
No, I was just getting ready to say I showed a house to a business owner yesterday, and it's a $1.5 million house, and the business owner owns a store, and so yeah, I mean, when you look at in this scenario, if you have a specialty store or a small shop, and people are spending more of their money at Walmart rather than a specialty shop, it could affect your store. And certainly these business owners, a lot of them are in these more expensive homes.
Yeah, I agree. Also, too, I think one of the biggest things that I've been saying on my channel is that a lot of, even that I was kind of calling that the banks would go ahead and cut some of these credit lines and whatnot, especially the higher, even though the closer they get to understanding, okay, where do we want to be on this risk bar, right? So the closer we get to the holiday season, the more they're going to restrict and cut, right? That's just the way that the cycle goes. And I've been trying to tell people, like, be careful of maxing out your credit lines and then going back for more. The questions and stuff that a banker is going to ask you are going to be hard questions for you to answer, and that you're probably going to get denied on. Hey, where do you see your business in 2 years? Because the way we're looking, this year, you haven't been doing well. You're going in a downward cycle. So where do you see and what are you going to do to make sure that you have a more profitable year than you are right now. Oh, do you have a business plan? Can you show us that? Can you show us in a breakdown, in a graph, in an Excel spreadsheet, how you're going to do that, and show us the cost and all this other stuff? It's going to be super hard, and most people will just say, "This is too much. I'm not gonna jump through all these hoops to get my credit line extended for more money." And so what's happening in those sectors is individuals have to start making a choice when it comes to, if your business is going down and you have no credit, because credit is needed to run that business, like you said, to buy inventory and what else. How are you going to be able to afford that luxury home when insurance is going up, when property taxes are going up? And even though a lot of people believe that, oh, property taxes won't really go up because I didn't just buy this house. Well, what about all the other houses around you that are getting sold for buku dollars and whatnot? That's going to affect your property taxes. And so all of these things costs are going to go up. But if your profit and the income that's coming in is going down, it's going to be tough.
Well, you're talking about property taxes. I mean, not to jump over to the residential side, but I just had a client called me up, and in the latest assessment, he got his tax bill, and he fought it, and he was really upset. He lost. He went after the tax assessor, and they ate him for lunch, and basically said, your house is worth this plus, right? And it's interesting because you remember back in the crisis, back in the '08 crisis, there was a new business that kind of spawned up, and they were sending everybody, when their property taxes were being assessed, they were sending people these postcards that said, "I will get your property taxes reduced, guaranteed, or pay us nothing," right? They made money based on the amount that they saved you on getting, your property tax reduced. I mean, guys, let's think about this. This is a genius plan, in my opinion, right? The Fed drops rates to zero, allows property values to skyrocket. Mm-hmm. They can assess everybody and make more money on the transfer of properties and property taxes, annual property taxes. I mean, it's crazy. If you added up, if you actually went on your county's, I challenge you to do this. Go on your county's, website, look up their financial statements. Look at how much money is being collected in your county per year on property taxes alone, and don't pay it. They'll take your house. One of the reasons why, if you want to know, when you are buying a home, that the lender or the servicer collects, escrows your property taxes, is because they know if you don't pay the bill, the county will come in and hold first position on your property, and that lender's screwed. Yep. That county will take your property for the $10,000 you owe $450 on it, but owe the county $10,000, and they're going to snatch it right up, and that lender's screwed. That's why they collect. If you want to know, that's why they collect. Also, why they collect your insurance premium. So when you're getting your next year premium bill or your next year's escrow, if you got a little coupon book, or whether you do it online and they send you that letter at the end of the year and say, because of your taxes, county taxes and insurance hike, that escrow that you've been paying every month isn't enough, and your payment's gone from $2,600 a month to $2,950 a month, because we need to make sure that we're covering that. And a lot of these buyers, they're getting a rude awakening, man. They bought a payment. They bought their house in a payment. They had no idea that these costs were going to go up. And all of a sudden now they're like, man, I financed myself to the hilt, and now my payments are going up.
It's brutal. I have a friend who told me he had just got a new build in Texas, in Dallas, and he told me his tax bill is $15,000 on a $350,000 house.
Oh man,
That's
Wow.
insane.
Where the heck is that? Where'd you say it was?
It's in Dallas.
Dallas.
Yeah.
Come on,
in
man. The
Dallas.
state that doesn't collect any state income tax?
Wow,
Man, they're
know how that
gouging on
goes.
taxes like that, boy. Shoot. But you know what else I heard they do in that great state? And look, I'm not picking on Texas. It is a great state. Everything's bigger than Texas, even the tolls, right? So check this out. So I have a couple friends that live in Texas, and they say during rush hour, they raise the price of tolls to try and keep people off the highways.
Well, I could see that happening easy.
Now, come on, man. You want to get to work? You going to stick it to me because I'm trying to get to my job? You going to make me travel on a back road and be late or get up an extra hour and a half early to drive? Come on. That's
You know, the
crazy.
funny thing about that, I have a story really quickly about that. Me and my family went to, it was somewhere in Texas, either San Antonio or Houston or something. And we get a rental car, and the lady's like, "Do you want this toll thing?" And I'm like, "Nah, we don't need the toll." And she's like, "Oh, okay." And I was like, "There's no tolls around here, right?" And she's like, "Well, you can get around them." And I was like, "Oh, okay." As soon as you leave the airport, there's a toll. As soon as you leave the airport, I'm like,
Or you just waved your credit card. You were thinking that would work, right? You just, here it is. Oh, man. Hey, look, I hate to see when you got that bill. Sheesh, because you know those rental car companies, they back bill you, man. They got your credit card.
man, they showed,
You get
they
that
did.
toll
They sent me a
bill.
bill too. I was like, oh man, it's crazy. The whole
So-
day's a rental.
Yeah.
Yeah.
Some more questions?
Yeah, well, I just wanted to. There were some check-ins about what is locally going on in the area, in Denver specifically. I was out to lunch in downtown Denver, and there was no one there to eat.
Cameron Jenkins, man, you get your shirt.
We need to know, Cameron.
Huh?
If you got his
I
shirt?
want to know, man, if you got your shirt.
Yeah. And then here's
And
another.
he went on and bought a Sachs Realty shirt. He got one of our quarter zips.
Yep.
Oh wow.
Man, that
We need
thing,
a picture.
Look at that, man. I tell you what,
Yeah.
you guys can go to our Sachs Realty website.
Yeah.
We got a shop, or you can just go to saxrealty.shop. We got cool stuff like this water bottle. Can I talk about our gear? I don't
merch.
even know how to get it in the shop.
Oh, yeah.
We got water bottles, keychains.
Yeah.
Man, we got some cool stuff. You guys want to
Yes.
look cool. I'm wearing direct mortgage tonight, but usually, you know,
I know.
you don't have a Sachs Realty shirt on, Melissa.
No, I don't.
You didn't get the memo.
I did it. I did it. I want one of these though. Pam, shout out to Pam. I need a shirt.
Oh, there we go.
Yeah.
It's up on the screen. You guys want to be cool, man. You should be gearing up, wearing Sachs Realty everywhere you go. When you go to some of these shopping centers, let's talk about that because the Wall Street Journal, everybody, mainstream media is reporting. And I have a hard time believing this, man. I got a hard time believing this. Headline news, bright spot in retail. Retailers are on track to open 1,000 net new stores in the U.S. this year as retail availability hits record lows in fresh signs of a sector's resilience despite turmoil in commercial real estate. Landlords say demand for retail space has remained robust this year, defying inflation pressures, interest rates, and liquidations, including Bed Bath & Beyond and the Christmas tree shops. How do they share the same line as Bed Bath &
mean-
Beyond?
People love that though. People love Christmas tree shops.
What? I've never even heard of it.
They do.
Come on.
No, they do. People love that. Yes.
365 Christmas tree shops.
I don't know. You go to the beach. What are you seeing? Christmas tree shops. People, you guys, tell me I'm not wrong, please. They love the Christmas tree shops.
How many freaking ornaments? How many? What?
Oh, it's a thing year round. They
Unfortunately.
love it. I kid you
Hey,
not.
look, man. I've seen people have their Christmas tree. I think there's songs about that. Christmas tree lights up all year round. I mean, it's like a darn, like a
Oh no,
got your
I don't
Christmas
know.
tree lights on. Mm-hmm. We got some places in Baltimore, man. They have Christmas tree lights all. They have their Halloween decorations up all year.
Oh yeah,
Ooh.
I know.
You know what?
Wow.
You know what? So check this out. This is you guys can Google this stuff, man. You know Halloween. Am I saying that right?
Halloween.
I got like my Baltimore accent going on. People are like, man, I say things like child. They're like,
Child.
what? You said that to me. You're like, what?
You
I was
do.
talking about
You
this
say a
child.
few
You're like,
keywords.
what? Child. Try not to. From Baltimore, man. What do you expect?
Oh, wild too. Wild.
Wild. That's wild. Come on, man. Cheesy peasy. You guys making fun of me.
funny.
Look, it ain't like y'all. Wild. Wild. It's really wild.
That's funny.
I could say something else too that really cracks people up when I say, make sure you check the oil.
Oh yeah, that's right.
Uh-huh.
That is a very
oil.
local
That is-
The what?
accent.
The oil.
It is.
Oil.
Baltimore.
Oil. Make sure you check the oil. Oil in your car. All right. Come on. Enough picking on Todd. What we're back to the Christmas tree shops. No, what I was saying is that this is like true. You can Google this stuff, man. Don't just take my word for it. Do you know they sell more in Halloween decorations than they do in Christmas decorations?
No, I didn't know that.
Really?
And I was in Lowe's the other day, like a month ago.
Yeah. They've been out for
And they had the,
bit.
you know, the big.
Oh,
It's
they had
fun.
I was
It's
taking
fun.
Noodle
videos
man.
of it. I'm like, man,
Yeah.
this is crazy, man.
I do. Spirit Halloween.
$1,000
Another
for
good
a
one.
ghost track. Whoa. It goes in here, man. We're getting way off track.
Way off track.
All right,
Way
no,
off.
look, seriously. They said that retailers, okay, check this out. They always throw these like curveballs. As of mid-August, are we in mid-August? Yeah, I guess
We are.
Retailers had announced plans to open nearly 4,500 new locations while shutting down about 3,500. That's where we came up with the 1,000 net. Orlando, do you believe this stuff, man? You think brick and mortar retail is actually on its way back?
No.
That's like a Halloween joke.
You know, maybe some of that has to do with migration. A lot of people move from California to Austin and New York to Florida, and a lot of that building is new building to accommodate more people in that area. That's what I would get out of that story, not a scenario where they're just building more and not closing down the others. That's what I would get, because it just doesn't make sense why. I mean, retail. I mean, we just saw from Cameron saying that he was just at a restaurant and nobody was there. So I mean, and it's not just him. I've went to grocery stores or went to a retail and there's like nobody there. Everybody is doing delivery and all types of stuff. So I just can't see a quote unquote resurgence of retail.
I remember,
not in the brick and mortar standpoint anyway.
So I remember one time, just true confession. We were like in the, pandemic, and, I'm like, man, I'm going to order this. I'm going to do like, I don't know, it was the local grocery store, and they had their, you order online and they deliver it to you. Man, you got to really be, I mean, you only do this one time, right? You see like snack bars, right? $2.79 or something, the snack bars. And I'm thinking like I ordered the whole box. And then all of a sudden my box comes, right? And I'm looking at my food and I got one snack bar. I'm like, you got to really look, you got to read that stuff. I mean, they will sell you one snack bar. You got to actually say you want 12 or the box or something like that.
Right.
Anyway, I can't imagine. So here's my take on it. I have heard where specialty stores that went online, boutiques, things like that, but popular boutiques. I'm not talking about the ones that are here today, gone tomorrow. I'm talking about like popular ones. It's so expensive to drive business to their store online because you have to use influencers. You spend however much money to have somebody mention your product. Thousands of dollars to these influencers, and then they don't get the sales to back it up, or they spend a lot of pay-per-click advertisements. So I have heard where a lot of these boutiques say, you know what, it's cheaper for us to have a brick and mortar and not even have it stocked, but really push them to the online store, or they just order it at a kiosk. They order online in the store. They feel the fabric, see yep, it's nice, it's orange, says direct mortgage on it, and all of a sudden you say, okay, well, what do you want? You want an extra large? Boom, you press that, and it ships to your house. But so essentially, if you're paying $2,500 a month, and you're in a prime location, or maybe it's $5,000 a month, but it's just a tiny store, right, or kiosk even.
Right.
At least it's exposure, to people grocery shopping.
Yeah, I mean, I can see that. That portion makes sense. But I think the way that article read, it was like full blown, like brand new store that most people would expect, like fully stocked, everything.
Yeah. So, what do you think about restaurants? Let's talk about that. I mean, you think they're in trouble?
Yeah, restaurants are always in trouble, man. I mean, in the commercial realm, restaurants are probably, I don't know, restaurants are low tier properties. You really have to do the underwriting on them and try to figure out exactly what type of food, what's the traffic, how many years they've been in business. Is their profit going up? Is it going down? You really have to really pay attention to a lot of, because something can change just as easy as a little bit of the food that they're serving to management, and it just tanks. So restaurants have anytime the economy is going down, restaurants are in trouble. It's just what it is. Normally we see hotels and restaurants. Those are really the two big things that just go down.
So with a restaurant, I mean, seriously, don't you have to ask them which cash register they're turning into you? I mean, as a lender, I mean, don't you? I mean, don't they have the cash register, and then the credit card cash register? I just find, through the years, restaurants, a lot of them, they're like, oh, we don't make any money, but they're driving Lamborghinis. Now, if you own a restaurant and you're driving a Lamborghini, don't be mad at me. I'm not mad at you. I'm just kind of curious, do they report all those earnings?
Yeah, you never know, but a lot of them have merchant accounts and whatnot, and so you get to see what they're bringing in through their merchant accounts and whatnot, and then who knows what the cash is? Maybe they're not reporting it. Who knows? But the point is,
I'm only kidding, Orlando. I'm not accusing anybody of not submitting their cash receipts. Come on.
But the point is that during these times, during any time that the economy is having some trouble, I mean, the first thing that you'll see in cities, and everybody can notice this, is that you'll start seeing, oh, this restaurant is closing down, this restaurant is closing down. It's really the first to get hit. It really is. Restaurants are just, the profit margin is tough, and people will. How many times have people said this? Hey, instead of I'm trying to save money, how about we just don't go eat out? That's the number one thing people say.
I have to tell you, the big thing is it's expensive to eat out, and it's a big disappointment a lot because the quality sucks. The service is not good. I mean, if you're at least going to go out and eat and waste your money, I mean, you want to at least be taken care of and get good food. So, I mean, I know a lot of the restaurants that I've seen go out of business, it's not very surprising, but at the same point in time, what do you think about oh man, I hope we're not going to, guys, don't start unsubscribing when I start talking about Airbnbs again, please. I mean, man, I got so much, man, I had man, I took a hit when all I did was mention Airbnbs, and they were like,
tread lightly.
Unsubscribe. My gosh, I thought people loved watching our show. I didn't know one word or 3 words, short-term rental, would do such damage. But let's talk about what the heck with these hotels. What are they I heard hotels are ramping up. Travel's good. Everything's good, by the way, Orlando. The whole economy is good, depending on who you listen to. But, I mean, are hotels going to be shutting down? What's up with that?
Yeah, I mean, hotels are always on the chopping block. Like I said, they're there with residential, and I mean with restaurants. There, as soon as the economy is going in one direction and people stop spending, then they're gonna not travel, and as they stop traveling, then they're not gonna use the hotels. And the same thing happens when companies start laying off people and they're pulling back. They don't want to send people their people on business trips and stuff like that anymore. All of those things will affect the hospitality industry. It really will. And they get hit really hard. And a lot of these hotels, they're huge properties with a lot of debt on them. You know, most of them, I would say, I don't know, we're probably looking at 60%, 70% are done SBA, and SBA is giving 90% leverage. So you can just imagine what the amount of debt that they have on it, and with property values dropping and income dropping, but expenses going up, it's a recipe for disaster.
Orlando, did you say SBA?
Yes, I did. Banks love SBA loans, man. They do.
What?
Banks love SBA loans.
Well, I guess they do, man. It's like nothing like having a stethoscope, shoved everywhere to the person getting the loan. I mean, man, I know, did you even say, like, you're not talking about SBA loans with like restaurants, are you?
Oh yeah. Yeah. SBA loans with restaurants, hotels, gas stations. Oh man, those are
Orlando. They get in your business. That SBA, man.
Oh, they do. They
get all up in your business.
But here's the thing. The reason why
business owners don't like that.
They don't. But here's the thing. The reason why banks love it is because they're protected up to 70% of that loan. So the government will, if that loan goes bad, then the government will give them 70% of that balance. So they're protected. That's the reason why banks love SBA. They're guaranteed.
The government guarantees everything.
Well, yeah, we'll see how that turns out.
They guarantee everything, man. Come on. Oh, hey, look, Orlando. Let's talk about a serious note here for a second, man. What do you think about affordability in America?
It's getting bad, man. It's just these, especially on the residential side, it's just getting ate away. Homes that were 200, 300, 400 now, in some instances, 500. Then you have inflation just on everyday goods, inflation on cars, inflation on services to fix up your house, to do anything. It's just becoming unaffordable all the way around. And, I would say probably this month is when I've been really seeing a lot of social media ramp up on how people can't survive living paycheck to paycheck. It's always been that way. I don't want to get that mixed up that there isn't a 65% amount of people living paycheck to paycheck. But I think a lot of Americans are reaching a tipping point to where they're just like we talked about earlier, where you're spending 50, 60% in housing. And on top of that, you still have other bills to pay, and you still have food to buy, you still have gas to buy, all these things. And it's just becoming extremely unaffordable.
You think we're going to see residential real estate prices tumble?
Yeah, I do. I think I'll see. The word tumble, I think they'll go down, and we're actually seeing that now, right? We're seeing incremental drops, right? Some areas are being hit harder than the other, like Austin and whatnot. But I think it will continue to go down. I mean, if you really think about it, if the demand isn't there and people have to sell, I mean, it has to come down, right? If interest rates continue to go higher, and if this Fed continues on his path, which he's saying he's going to continue on this path of 2%, if he's going to do that, he has to continue to raise interest rates. That's what he said he's going to do. So if he continues to do that and interest rate continue to go up, yeah, I mean the demand. No one wants to buy a home that's overpriced that they can't afford already at 9-10%. Nobody wants that. Nobody can afford that.
That creates a whole nother problem, though, because if you look at how many loans were originated in the last 3 years with the current home prices, I mean, let's just take, a $500,000 house. If the value of that house goes down $60,000, $70,000, right? Which is not, that's not hard to, it's easy to believe that it could happen.
Right.
And, and I don't know that interest rates need to really go much higher. I think they just need to sustain where they are. I mean, I think even if we dropped or even watched some kind of a pullback to even mid sixes, still, when you look at, 4% versus 6.5%, that extra increase in interest payment really makes it prohibitive for, most borrowers to buy a home. So I think I think it has to happen. I mean, a lot, we've seen it happen, but we get a lot of people, they want to fight on it. And look, I don't want to fight about it, man. I don't want to, be the one to be right. But I think that just looking at the numbers and looking at how artificially inflated everything was, we were in an everything bubble. Orlando, man, have you any idea how many car repossessions, how many people have turned back the keys to their automobile? I mean, financing cars for 7 years. Yeah. I mean, it's just crazy. We just had somebody wanted to rent a house, owed $7,000 in their car payment. They turned the keys back in. And what happened was the bank, it was on their credit. The bank sold the car, and there was a deficit of $7,000 from what he owed the bank to what the company was able to sell the car for. You just look at that. I mean, we're talking about, transportation costs went through the roof, right? So, I mean, I think it's just inevitable. It's inevitable.
Yeah, and when you look at, like you were just talking about cars, Tesla, I did a video on this explaining that he was going to do that he's doing currently a 7-year loan, and he said that if the Fed continues to raise rates, he will go all the way up to 9-year loan. He will provide a 9-year loan for Tesla. Now, how crazy is that? How just doesn't make any sense.
How long do those batteries last anyway? Like 7 years? I don't even think the batteries last 9 years. I don't know.
6 years, something like that.
It depends on where you live. If you live in Texas where it's 110 degrees, that's hard on batteries. I mean, I don't know how many Teslas are sold. Somebody said something to me the other day about Tesla. We're talking about, how many cameras are on a Tesla?
No, a lot though.
A lot, right? Because I mean, they're autonomous, right? Essentially, they drive themselves, or they can, right? So, a friend of mine has, he works on cars and pulls these Teslas into his shop, and he's like, man, I bet this Tesla is recording everything that's going on in my shop. I mean, I don't think these cameras ever really shut off. I mean, it's like the camera on your phone. I was thinking about that the other day. I'm thinking like I have to get permission from people, talent release forms, to have them on shows and things like that. But you go out in public and you know that you're being recorded, but that's a public place. But what about when you take your Tesla to a non-public place, like your friend's house or your mechanic's garage to get hand washed or whatever? You think they're going to have privacy lawsuits or issues, man, with these cars that record everything all the time? I mean, don't you think? I think that they're probably collecting all the data from all these cameras. Heck, they may even be collecting audio inside now. Who knows? That's just a different
you know, the
thought.
funny thing about it is I'm pretty sure that is the case, because if you watch some of these, if you watch like videos online where people are like scratching other people's cars and doing all this, they take the video from a Tesla and the person's like in the store somewhere. Like it's just sitting there. So it's recording, of course. Or I've seen something happen on the street and someone pulls the footage directly from a Tesla. So they'd be like, "Oh, look, this is what happened on that street while you were eating dinner with your family in the house on the street." Like, you know, so yeah, it definitely is recording.
Wow. Wow.
You didn't think about that, did you?
No. I don't know how I feel about that.
No kidding. Elon wants to give people 9-year loans on their Teslas. He wants more eyeballs on the street.
That is
I'm
really.
gonna look that up. How many cameras are in a Tesla? How many cameras? I don't know, Joe. You may be able to tell us now. How many cameras?
There is no privacy anymore. I mean, there's a lot of potential watching on you at all times.
Mm-hmm.
I can't think
Yep.
about that too much.
All right, what else we got? Questions.
right.
My mind's already going. I'm thinking to
know.
myself, man, I hope I didn't. I mean,
Oh gosh, let's talk about the rent though.
how many?
8.
8? Only 8? How's that work? 1 in the front, 1 in the back, and 3 on each side, maybe?
You mean the corners of each? Yeah.
Mirror.
Those things,
Mirror.
do those things, do they record sound too, Joe? Oh, yeah. Man, what about that Privacy Act? Is that like in the agreement that you sign when you buy a Tesla? Maybe, but
be
not
in
in
the
my
fine
agreement to
print.
have you in my... Oh, I can't even think about this. Come on. What else?
Okay, let's talk about this. I want to know who's paying the rents. My old apartment went from $2,400 to $4,200 a month in 2 years. Who can pay that?
Jeez. Wow.
Yeah, that's tough.
Yeah.
Well, I can give you my perspective because I'm a property owner myself. So, you know, what I'm starting to see, and especially when it comes to multifamily, is it's becoming tougher and tougher to get tenants to stay, getting tenants to come into the unit itself. And not only that, but tenants are expecting more, right? You know, a couple of years ago, 3 years ago, you could just, not really fix up the unit. Now tenants want brand new units, and you're competing with brand new units if you have an older apartment complex. And unfortunately, there are a lot of owners out there that are in the mindset of, well, I'd rather keep this unit vacant rather than have someone rent it at the $2,400 that she was talking about. Because in their eyes, if they bring the rent down to that $2,400 and every other tenant realizes that it's $2,400, they're going to want $2,400. They're saying to themselves, the other tenant is going to realize you're paying $2,400 and they're paying the $4,200. So in that case, I'll just leave this vacant until someone comes and pays the $4,200. And that's kind of the way that the market is going with multifamily. And not only that, but multifamily has been the darling in commercial real estate for 10 plus years, easy, right?
You know,
and the vacancies are just rising, 9-10% in some areas, which is really unheard of. And it's going to continue to happen, especially with all the new product that's coming onto the market, flooding the market. It's getting insane. It's going to get insane. So if you have an older property and you're an investor, you got to keep up. You got to keep up.
You know, you brought up a great point, because what I've seen multi-family operators do, instead of reducing rent prices, because you're exactly right. That's like the kiss of death, man. I mean, so all of a sudden, you're charging $2,400 a month for a 2-bedroom apartment, let's just say. And then all of a sudden, to entice, someone, you've got to drop it to $2,200 or $2,100, right? The next thing you know, I mean, you just really screw to all of yourselves, because your tenants are going to be rolling out or coming back to you and renegotiating. But here's what they'll do. They'll say, I tell you what, to get you in here, we're going to do a 15-month lease at X amount of dollars a year. And basically they'll absorb or drop it'll seem like you're paying a lot less per month. The per month rent is the same, but they're giving you an extra 3 free months on the lease or something like that. So they get creative. And, and that's the exact same thing. That's the exact same thing I saw, builders, they're doing it right now. A lot of home builders, they've jacked the prices up because a lot of them are still giving, 4.5%, 5%, 30-year fixed rate mortgages, right? And they've got to buy that loan down to get you, to entice you to take the bait to buy the house. So they've been raising the home prices, right? So what would happen is if they, instead of giving you a break, buying down your loan, if they drop the home price, which essentially is the same thing if you think about it, think about how upset their community is going to be, right? Think about all the people that have already signed a contract and they're waiting for their home to be finished. They'd have a disaster on their hands. So that's why when we see, home builders, a lot of times they're raising prices or they're not slashing prices, but they're giving incentives, is because they have to be very careful in what they do to their comps and to the people that have bought their homes. So it's a slippery slope. At some point, I believe it just doesn't matter. It gets to a point to where, they're going to have to do what they have to do to sell the inventory. But, there's and I'll give you guys somebody to look up. And in fact, I'd love to talk to her on our show. But her name is Ivy Zellman. Zellman and Associates is, her business. But they are housing market analysts and, advisors. And they deep dive into this. And actually, Ivy, she predicted the housing market crash. And I was just listening to an interview of her. I respect what she has to say. And she really says that, she believes in a couple things. I mean, she's not talking that we're going to see this massive implosion in the housing market, which I don't necessarily, agree that we won't see a much more significant downturn. But she really thinks that a lot of these builders eventually are going to cut their costs because, their operating costs every day go up. So it's like having a vacant property. It's like having a listing that you're paying $20,000 a year in property taxes plus insurance, and all of a sudden it's sitting there vacant, and you're looking at it and you're going, every single day I'm losing X amount of dollars. So if this thing sits another 3 or 4 months on the market, I'm better off liquidating the price today and cutting it loose. So I think it's going to become a point in time when we really start to see the builders, dumping their inventory. But the other thing that goes with that is we're really not we're in a population decline. And, if you look at, mortality rates over the last several years, you look at, younger people are having kids later in life. They're not having as many kids. I mean, over decades now, we have been seeing a significant population decline. Now, if you look at the numbers, they're skewed by immigration. And I'm not talking about legal immigration, but we're seeing a lot of immigration happening, which is really bumping those numbers. But I think, I don't think we're in an inventory shortage that everybody complains about. I think that what we have is more people have second homes. We do have a lot of short-term rental inventory that's sitting vacant most of the time. I think we're going to see a lot of these hit the market. I think that we're going to see a lot of landlords get out of the market because they realize that the downward pressure on pricing, the Fed said it himself several times, that, we're going to see housing shelter inflation come down. And he even says it just takes a cycle for leases to wear out and to where these people are going and moving into less expensive housing. They're going to be sure to do rent controls. I mean, they're going to make sure that, these rents, this is not a good time, in my opinion, to be a residential landlord, unless you're Wall Street. But, I don't think it's a good time for that. And I think we're going to start to see where it ran its course people are like done with it. They have a bad taste in their mouth. We've glamorized it too much. Too many Instagram posts and TikToks about how this is my jet and I have, $1.5 million in rental income off of the backs of the working class. I think that this is the battle that's going on right now. And I think people are tired of it. And I think a lot of people are putting their foot down. Their multi-generational housing is coming more into play. I don't know, man. What do you think, Orlando?
Well, so when I do consultation with like apartment owners and people who own property, what I try to explain to individuals is, look, 2023, 2024, and maybe 2025, it's not going to be fun. It's not going to be fun to be an apartment owner, right? You're going to need to work on trying to keep your tenants in, keeping your tenants happy, right? This ridiculous raising rent by $300, $200, your tenant's gone. Your tenant is gone. And then you got to spend the marketing dollars to find someone to put them in. The vacancy is probably gonna be higher. So you're losing money on that. When if you just would have just worked with the tenant, maybe raised it up a very small amount to make sure that they were there and signed another year over, you would have been better off doing it that way. Reading the headlines and thinking that, wow, everybody's raising rent by $400. Let me do that. That is a quick way to empty out your apartment building. That is a quick way for your property to go into someone else's hands at a fire sale. So if that's what you want to do as a property owner, then go right ahead. That's what's going to happen if you continue to do that. And so I try to explain that to individuals that it's not going to be fun these next 2 to 3 years. It's not going to be an Instagram post. It's going to be tough. It's going to be hard.
But Orlando, what about these operators that have promised double-digit returns? I mean, I know there's no promising, but they're out there saying, we've been delivering 12 for 14% and this and that and the other, and they've been pulling all this money. They get their SEC filing, stuff straightened out, and they pull this money together and syndicate these deals, and they're the operators. The investors are the ones going to be holding the bag. I mean, I'm sure, there's, poison pills in some of these deals, that basically say, hey, we're okay, but sorry about your luck of the investment that you put in. So, but I think about, I keep going back to, who I deal with every day. I mean, as a real estate broker, I mean, we deal with landlords. We do tenant placement. We hear their concerns. We see the places that have been trashed. A lot of these mom and pop landlords, or don't even call them mom and pop. They're just, a lot of people that thought they bought it hook, line, and sinker. Hey, the Burr method. I'm going to do that. I'm going to get the house. I'm going to get my money out of it. I'm going to, move on. I'm going to buy another one. And as long as it cash flows something, right? But a lot of these people that are buying them don't realize they're making $400 or $500 a month. Okay, in clear. Now let's just say $400 a month times 12, $4,800. Their tenant moves out in 2 years or 18 months, and they spend $10,000 getting it ready to rent it again. I mean, or more. I mean, I've seen them hurt by it, right? I mean, that's a good scenario, right? And then you could say, yeah, but they're buying down the loan and all that stuff, and you're going to get the home appreciation. The problem is these people don't have the money to float it. That's where they get in trouble. It's true that if you keep it for 20 years, your tenants are going to pay for it, and then you still have the asset. But the problem is they get in trouble because they bought into this philosophy that they could get into the game with no money down, or put their money down and get it right back out. And I think that's what we're seeing when I say it's not a good time for landlords moving forward. That's what I'm talking about, right? That's exactly what it is. So, and the other thing is, let's just say you bought a house for $400,000 and you're renting it for $2,500 a month. Is that a good deal?
Well, this is a great topic for me because you're speaking to a guy who I see some of these offerings come up and I have no interest in really investing into them, but I just want to break down the numbers just to see if it's a good deal on on my spare time. And I show my wife, and she's, you know, deer in headlights. She's like, why are you even doing this? It makes no sense. But I
who
love
would do
doing
it?
this stuff.
Yeah. Oh no, but I'm saying it's
But-
good that you're
but-
doing it. But who would buy it? Who would buy it?
But this is what I'm saying. A lot of these guys bought these apartment complexes, and they bought them at like 4.3 caps. These insane cap rates that I couldn't even figure out myself. Why are you buying a $50 million property at
3%?
3% cap rate? Like, it just didn't make sense to me.
Well, because Orlando, rents are only going to keep going up, and we're just going to charge these tenants more money for the same junk that they had when they were paying a fraction of the cost.
Well, what's going to happen with these syndications is that there's only two options, right? Either you give the keys back and everybody loses, or you're going to go back to the same people that you asked for syndication into the thing, and you're going to ask them for more money to pay down the loan. And so that's what I'm starting to hear. A lot of the rumblings is like, hey, look, we overpaid for this property, so we're going to go back to the well, and we're going to raise an additional $6 million to pay down the loan, to force the cash flow to happen. And that's what I'm seeing a lot of individuals try to do. Now, a lot of people are having a very hard time doing that. A lot of people are having, because the money is gone now. People are thinking, why do I got to pay you more money when I'm not getting my 8% that you promised me that I was going to get? So if I give you more money, am I still going to get the 8%, or am I watering down my own position?
Hey, Orlando, I gave you another $100,000. Yeah, I know, Todd, but if you don't give me another $100,000, you're probably going to lose the first $100,000 that you gave me. And I know I was promising you 9%, but now I'm going to give you 3%.
Mm-hmm. Yep.
Sounds like a good deal. What am I going to do? I don't know. If I put it anywhere else, I'd probably get 10% or 12%, but I'm stuck. All right. So you're right. This is, yeah, look, man. And this is exactly why I say that what we are doing right now is not sustainable. We could argue the fact all day long that prices are going to just keep on going up, and eventually they will, but not until wage growth goes up. I got news for you. I mean, right now, until we start seeing people making more money and being able to afford, or we start seeing deflation, it's not. I don't see it.
How long is that going to take?
Man, I don't know, man.
How long is that going to take?
Right, because now the businesses have no credit lines. They're past due in their rents. Their businesses are suffering now, so their employees, I can't pay you anymore because now I'm actually making less money than I was when, I guess, I don't know, Orlando. They need to crank the money machine up again, I guess.
Well, we saw where that got us.
Yeah, we're waking up from it now. Let's take some more questions before we sign off.
This comment is following up on when you were talking about the investors. Here we go. I'm not big on laws, but it seems like we should limit the sale of homes to people who intend to live in them. Investors are killing the American dream of home ownership.
I have a very unpopular response to this.
Okay, let's hear it.
Okay.
And investors aren't going to like it.
Okay.
But when you go to HUD Home Store, right? You know where I'm talking about, Orlando.
I
right?
do.
All right. So you go to HUD Home Store. What happens is when HUD forecloses on a home, they offer it up to only homeowners for 21 days.
Yes.
You have to wait. If you're an investor, you have to wait before you can bid on it. And if a homeowner doesn't buy it within that period of time, then it opens up to anyone else. I think nonprofits can buy it, homeowners can buy it, owner occupants can buy it. A very easy solution here, but it's more regulation. And, that's not the nicest thing either. We never want that because, it starts chipping away into freedom and things like that. But at some point, you have to sit there and wonder, should someone who needs a roof over their head be outbid by a cash investor when you're seeing cash investors buying properties. And by the way, Wall Street companies, man, they are licking their chops in hopes that the housing market takes a deep dive and they can be there to own even more of the. I mean, look, you've got this is a finite product here, right? It's regulated. Housing's regulated. You just can't build it like you did in the old days where you're like, hey, I have this property and I want to build mom and dad a property, or I want to build the kids something. When you look pre-zoning regulations, pre-World War II stuff, right? We start to see where these people just did whatever the heck they wanted to do, man. They just lived, right? So they built their compound. Their family lived on one property. But what if we look at, a finite product like housing? Well, how do we know that? Because it's regulated. How do we know that? Because they don't issue building permits. They don't just cut down trees, good or bad or whatever. I mean, we got a problem here, guys. We need affordable housing. Step up and do something now. Forget the red tape. Step up and do something about it, okay? But we've got a controlled amount of product, right? And so now how do we control that and regulate it so that the prices don't crash, that the Wall Street investors don't get hurt, that the insurance companies don't get it, the banks don't get hurt? I mean, forget the people, but let's worry about all these, big lobbyists and these big, supporters, campaign supporters that helped us to get here, right? But and not a popular topic, right? But here's the thing, It is for the people that need affordability. But the question here is, you've got a finite product, is regulated, and now they're gobbling it up as quick as they can. Some cities, 40 to 50% of the home sales of single family houses went to investors. For years, 33, 35, 36% of single family home sales, corporations, turning communities into rentals. Let me tell you something. If you control the density, the housing population, the building industry, you control that. Where does it stop? So to this commenter, right, this is a great idea. How do we curb for a period of time, get rid of the investors, get rid of the non-owner occupants, the ones that aren't going to live in the property? You're going to have to give a first look period and say, look, if you're not an owner occupant. Now, there are people that violate it. They break the law. They say they're going to live there. They don't. I tell you what, you can go to prison for it, right? I mean, it's a fact, right? You're signing affidavits on this stuff. If you don't change your license, we're going to check it out. If your license doesn't get changed, your driver's license to that address within 3 months of it, you're in big trouble, right? We got a problem here. So if we did something like that, but then the homeowners are going to say, well, that's ridiculous. I want these investors bidding up my prices. So where do you win, right? You got both sides of the coin. The buyers want an opportunity to buy it. The homeowners want every nickel that they can get. I understand that too, right? What do you do, Orlando? What's the answer?
I don't know what the answer is, but I mean, I'm not against limiting investors on the amount of single family homes. I mean, if you look at like the Black Rocks and these big hedge funds, I mean, they're buying thousands and thousands and big block tranches,
hundreds of thousands
of homes, right? And I just think that that shouldn't be, right? So I'm not opposed to limiting the amount of homes that an investor can buy, right? Because to me, it seems like if you were going to buy like 10, 15, 20, 50 homes, like that probably should be enough, right? And plus, I'm on the commercial realm anyway. So for me, I'm apartment complexes versus single family. But I do like the idea of the limitation that HUD does, where it's like, okay, there's a certain amount of time here, and then after that, everybody else can jump in. So I kind of do like that. But this is America, it's capitalism, so that'll never happen anyway. So, but it's good to dream, right?
Yeah. Well, again, I think it's a good argument. I know that there is proposed legislation to try and preserve home ownership, and I think that they are working on something. I did see a bill that the Biden administration, I was starting to read up on a little bit. I need to go back to it because I want to cover it. But I do know that there is a bill that is out there that is trying to, do some deregulation to encourage developers to build single family housing. And that's really what we need. I mean, we got to get back to not building these McMansions. We need to encourage builders that they can actually make money on building a 14 or 15, 1,600 square foot home, to where every home doesn't have to be 3,000 square feet, 2,700 square feet.
Man.
Because if you just take the cost of the building and then the development and all of that, I mean, let's take the builder's profit out of it. Let's say it's an $850,000 house, okay? Or more, but let's just keep it at 850. And let's say the builder makes $100,000 in profit. So drop that down to 750,000. That's still not affordable.
Right.
I mean, that's not what we need, right? We need more $300,000 properties, and a nice home for 300,000, 350,000. I mean, that's what we really need, or less, right? But I'm talking about across the country on an average.
I just want to have this comment come up right here, because this viewer did say one thing nobody talks about with these new homes is the obvious decrease in square footage. So where they are, they're saying, I don't see any new homes being built over 2,000 square feet in my market. Everything is 1,500 and under.
Yeah, I'd love to know where that market is. Yeah. I mean, maybe they're, single story ranch style houses. Mm-hmm. And again, I mean, depending on, where it is, I mean, we're not seeing that. I mean, most major cities are, 2,700 square foot houses. And, and they have HOAs. So you're getting jacked on that side too.
Right. Yeah.
I did a video of that.
Yeah.
Oh, man.
Yeah. Let's take a couple more before we sign off.
So I have a good one here.
And guys, check out Orlando. If you don't know who he is, I mean, he's a great friend of mine. And, we've really been tracking the economy over the last several years. He has an amazing channel. Cruise on over to his channel, show him some love, subscribe to him if you haven't already done so. And he's a good guy.
Let's take this question. In 2020, is 2023 a good time to buy a house? Why or why not? Please don't say it depends on someone's situation. In 2020, 2021, it was a straightforward answer. Orlando?
No.
I'm glad I had to.
No.
Man, I avoided that one. Jeez.
I mean, on my channel, I'm pretty straightforward in saying don't buy a home. I really tell people to sit on the sidelines with a purpose. And what do I mean by that? I mean, do the research, make sure that you're actively looking at your market so that you know what's coming on the market, when prices drop, exactly what's happening. So my answer to that is no.
Yeah. And I'll throw my 2 cents in there. I'm going to say what you don't want me to say, and I'm going to say it depends on your situation. And I don't mean that to be, to avoid hitting the topic head on. Do I think things are unaffordable? Yes. Do I think that the housing market is going to soften? Yes. But there are some people that they have plenty of money. I mean, to them, it's not, if they lost $50,000 or $30,000 for, the next 5 or 10 years, if they're going to stay in the property, it's not, the end result is home prices are going to end up climbing back up again. So no matter what we see in the cycle, there's a period of time, if you need to sell quick and you're going to move in 3 years, it's probably not a great time to buy in 23. If you're making a lifestyle choice and you can afford it and you have plenty of money in the bank and something opens up that checks your boxes, don't stretch for it. Don't stretch for it. Don't go in an area that you didn't want to be. You have something ideal in mind. Don't look at a place and make sacrifices because there's no inventory on the market necessarily. Right? Don't say, well, we can always change things around necessarily, right? Because if that's not something you're good at, and construction's not in the plan, it probably won't happen. And 10 years from now, it will look exactly the same as it did the day you bought it. So, I mean, there are certainly reasons where people are like, I don't care. If I bought a $500,000 house today and I know it's overpriced 50 grand and it drops to 450 in 6 months, I don't care. I'm going to stay here for the next 10 years. Then why not buy? I mean, come on. I mean, look, we know housing is a lifestyle. Look, I'll say something else that isn't very popular. Okay. People want to say that the house is an appreciating asset. It's not. The land appreciates. Don't believe me? Don't do anything to your house. Just live in it for 20 years. The walls will fall down around you. Your roof will go bad. Your heating and air system will stop working. When you buy a house, you continually spend money keeping it up. If you live there 20 years, right? Yeah, it will appreciate, but not like if it had a brand new kitchen, brand new bathrooms, brand new flooring, brand new paint, brand new roof, brand new heating and air conditioning, brand new window replacements. Okay, so what happens is people live in these houses. Never before have we witnessed what we saw the last 3 years, where the sellers could live in a house, do nothing because of the whatever frenzy. I don't even call that price appreciation. I call that craziness. I won't say stupidity, but I call it insanity. Right? When we started seeing people overpaying for houses, how do we know they were overpaying? Because it didn't appraise. That's how we knew they were overpaying. Somebody said, well, how do you know they're overpaying on a house? Because it wasn't worth what they paid. So they had to bring $50,000 in cash. Is it unreasonable to expect that appreciation was not really justified or not normal because it was situational, because we printed more money than we ever did? We dropped interest rates to 0%. Now we're waking up from it. Is it unrealistic to think that appreciation may get lost? That overprice that you paid, you may lose that money if you go to sell it in the next couple of years. Not a popular conversation, guys. Right? But I mean, come on. We gotta be, I'm out of my secret potion, Orlando. I hope you don't have anything bad to say.
What was in that secret potion?
We don't know.
I'll never tell.
We're not sure.
You guys got to keep guessing, but I'm not slurring my words. So, I mean, it wasn't moonshine. That's the kind of jar you'd expect to see moonshine in there,
100%. Go to Gatlinburg. They're all in that.
Not that I know anybody that has moonshine or anything. All right, one more.
Okay. In Todd's poll, he asked a great question. Can we pull that poll up?
Oh, thank you
Joe?
so much for reminding us of this,
Yeah.
Robert. Jeez. How can we
I'm
forget?
just curious where we are in that, but I'll go on. We now face a work from home workplace. With recent new COVID fears, why invest in commercial office space?
I can't think of any reason to invest in commercial office space. I wouldn't do it.
I would never.
I think you'd be foolish.
Do not do it.
Call it like we see it. And look, and for all these people that have been like, they're down in like Jupiter, Florida, and they got these office buildings, and no, I'm not plugging or, I don't have any problem with people in Jupiter, Florida, but I just know some building owners in Jupiter. And, I mean, they're like, they're cruising along at retirement, and they're like, man, I ain't doing anything with that building. I'd be nuts. Commercial buildings stand, and Orlando touched on this, commercial buildings stand 80 to 100 years. It's not uncommon, right? We look at an 80 to 100-year home, and we're like, man, that thing is either really cool or freaky scary, right? And it should be torn down. depending on whether it's been maintained. If it was an appreciating asset, it would still be great, but it could be a teardown, right? But the thing is that these buildings, to retrofit them, sometimes not very cost efficient. But like here locally, I don't know about all around the country, but I know that we can convert office space to residential very easily because it's a reduction in density. So when you look at office space, and let's just say in Baltimore County, you need 3.3 spaces per 1,000 square feet of parking versus 3.3 parking spaces per 1,000 square feet. Where if you have a 2-bedroom apartment, that goes down to like 1.5 spaces. So now all of a sudden you've reduced the amount of parking you need. And usually these office buildings have a lot of parking. So with that being said, you can get the, easily through zoning, but like Orlando was saying, it's not cheap to build them out. So you got to really steal these buildings, to make it worthwhile.
Oh, there it is right there.
All right. There we go. Offices going down.
Yep. Office buildings, I'm telling you, it's just, I would say no one, if you're looking to invest in commercial real estate, office should be just off the table. What you're seeing is you're starting to see like a lot of the hedge funds come in and purchase these office buildings because they're getting them at half off or more, right? And they feel to themselves that they can withstand the cash flow crunch that they're currently having, and that when this cycle is over, they'll benefit from that. But let's just think of a regular investor. Can you withstand 70% of the building being vacant? No. So why even put yourself in that position to even if you are getting it? Because this is what I've seen, Todd, is that I'm seeing individuals getting 50 to 60% off on an office building, on a regular 8-unit office building, and it's still not cash flowing.
Yeah, it's too much, right? So you look at that and you go, I have a client right now that's looking at, office space, and we're looking at buildings, 700,000, 1.2 million, 1.5 million, whatever. And my client's like, well, what do you think? I'm like, no, right? That's crazy. The numbers don't pencil out. And then if you look at it as if it was half price, they still don't pencil out. With the amount of money, these owners are screwed. The banks are screwed because, and I think that's the crisis problem, why the Federal Reserve is like, hey, we got to put these trillions of dollars here on the sideline so that we can lend these banks money at par. We let the banks invest all of the depositors' money. So if they take hits, these regional banks, on this commercial real estate stuff, they're down the tubes, right? And we're looking at more bailouts and really trying to rescue, like we saw with the bank collapses in March, right? So what the issue here is this. You take a look at this. Guys, if you want to buy an office building, you will be able to do it on nickels and dimes on the dollar, I have a feeling. It may take a couple years to get there, but I think that's going to be the facts, right? I think we're going to start seeing. But again, Wall Street's chomping at the bit, man. They are ready to take. They have the money. They have the funds, the hedge funds. They are ready to buy this stuff from the banks for the nickels and pennies on the dollar, right? They can turn those into mixed-use communities. They can get it through legislation so fast, through zoning. They don't even need to think about it. And they're just standing around like, I saw, a couple articles where they said, a lot of these hedge funds are dumping residential property. Why? Because they're getting their cash ready for the commercial tank, right? But let's put that back up again, that poll, because before we jump off, let me just, whatever. And there was a couple things in there. Number one, retail was second in line, right? And, what we just saw in mainstream media is that retail is strong and building. We got a net 1,000, retail units going up across the country, 3,500 of them closing down or being torn down, 4,500 of them being built. So whether you believe that or not, I don't think the retail sector is going to do as strong I'm with this poll right in line with it.
Yeah,
I
I don't
think
either.
retail will be number 2. And then wherever the industrial, the problem is, and I love industrial space. And if any of you are listening and you have
Yeah.
money that you want to invest, right? Industrial space is just priceless if you can get
So
your
good
hands
right
on it.
now.
Yeah, because guys, they don't want it. No one wants industrial space. It's not like they're saying, hey, let's put a manufacturing plant right here in the middle of a residential neighborhood where it's bang, bang, bang all day long, right? People would go nuts. So when you look at industrial space, contractor yards, things where you can have outside storage, contractors aren't allowed to park their trucks with markings on them in HOAs or, apartment complexes or condo buildings. So these people need space and they're great tenants and they're always going to be busy, right? We always need our blue collar workers. I was for many, many, many years. I still consider myself a blue collar worker. I've got an orange collar on right now, but I mean, this is me. This is how I'm most comfortable, actually. But let's look, industrial space. They believe I'm right in line with this. That would be the least to be impacted. And hospitality, I'm surprised hospitality is so low because I've seen more hotels, excuse me, more hotels convert to full-time apartments than I've ever
yes.
seen. Yep,
Yes.
we're seeing
Yeah.
it. We're seeing
Yep.
it. Orlando,
Yeah,
brother, I love you, man.
No, yeah, man. Same here. Is that what I'm starting to see is that, like you were talking about, the industrial is just doing so well, especially flex space and stuff like that. In the Chicagoland area, it's just booming, and I've been really waiting to kind of see if these cap rates would start to rise with this industrial, especially with the flex space type stuff. If that's because it's been low for so long, and it seems like every property that comes up on the industrial side gets, snapped up fairly quickly. But I'm very interested in seeing what starts happening when a lot of this, like, I don't know, when the spending and stuff starts slowing down from the consumer. Will all of that space be needed, and will some of these industrial properties come back on the space, back on the market? So I'm really kind of interested in kind of seeing, and I think last time I was on here right before the holiday time, is I still think the holiday time is really going to kind of tell the story of what's going to happen into the next year. So I'm really looking forward to kind of see if we get those record-breaking spending, yearly numbers that everybody's used to hearing. And I don't think we're going to get it this year like we did, like the last year before that. It was down, and I think it's going to be down even more.
Last year surprised me. They said it did so well. I was like astonished. That
Yeah.
they said that the holiday season was so robust. But Orlando, I'm with you 100%. I think that, you can look at industrial space in two different ways. A lot of the industrial space was occupied by Amazon type, operators, right? They became distribution centers because people, if you think about it, no matter what time we're going into the future, people will always want it faster than we've ever had it before. So now we're into same day deliveries, right? It is impossible for these companies to offer same day deliveries if we don't have distribution centers in just about every neighborhood, right? To be able to get the products to the doors. But what I'm talking about is we need to start seeing more manufacturing right here in the US of A. I hear everybody talk about a global economy, and I get it. But if we didn't learn anything during that pandemic, is that we can't rely on supply chain to get us the essential things that we need right here in the country. And I think going forward, we need to demand that as Americans. I think we need to start seeing more manufacturing here, seriously. But this warehouse industrial space, I think, will be good. And if you guys are listening tonight and you have businesses and you're a contractor or you're a local operator or a local manufacturer or a local print shop You make shirts like the one that I'm wearing right now, right? You've got your business. What I'm going to tell you right now is that you should be following this industrial flex space. You should be buying your location. Buy your location if you have an opportunity to do it, because if you go to sell your business, it's nothing without the real estate. And if you guys need help with that, you can reach out to me. I know commercial real estate brokers, especially like Orlando, that we can help you. We can put you in touch with people. If you want to buy your location and your business is doing well, let's get you investing in your own space. I think, guys, it's a good thing to do. So anyway, Orlando, thank you, brother.
Thank you. I really appreciate you guys bringing me on. Todd, Melissa, it's always a pleasure.
Melissa?
We're extremely fortunate to have this time with you tonight, Orlando. Really just so great. So great to see you again. And thank you for everyone who tuned in tonight. It was great with your questions. Really good stuff. So very thankful.
Yep, great show. And we appreciate Joe behind the scenes that hangs out with
Absolutely,
us every
always.
Tuesday night.
Always.
Guys, just very dedicated. And we love you guys. We appreciate you spending your Tuesdays with us. And hey, if you're watching this and you can't see it on Tuesday night, you're watching it later, we appreciate you. And guys, the biggest compliment that you can do for us is actually share the video with your family and friends to help us get information out to the public that you're not hearing in mainstream media. This is why we love the YouTube platform so much. If you haven't subscribed to our channel, if you could take a moment and do that now, if it's not too much to ask. If you like the video, you can let Orlando, Melissa, and I know by smashing that thumbs up, guys. Until next week, we'll see you soon.
See you soon.
Yeah.